Welcome everyone. It's a great pleasure to be here, and we have a exciting session. At least if one reads the topic of the session, it's quite exciting and very positive. And I'm very happy to be joined by some of the key experts in Europe and on the topic of ETFs. And I would like to ask them to introduce themselves.
Hello, my name is Jürgen Blumberg. I work for Goldman Sachs within the Goldman Sachs ETF Accelerator team. We help our investors to launch their own ETFs, and I'm the COO for EMEA.
Hi everybody, James McManus. I'm Chief Investment Officer for Nutmeg, and I also head investments for JP Morgan's consumer business in Europe.
Great, thank you. Before this session, I took a quick look at the numbers, and we have seen now 12 consecutive months of inflows in ETFs in Europe. Year to date, net new assets of 103 billion. It seems like a story that goes on repeat. And maybe a good starting point is to actually try to unpick the title a little bit, the ETF Advantage. What, in your opinion, is the ETF Advantage behind this continuous success of the product?
Yeah, I think it's very interesting because exchange-traded funds are around for quite a long time, 30 years approximately. And there was continuous growth. However, we now see that it's almost this logarithmic growth over the last couple of years. And I think in general, ETFs have a lot of advantages which resonate well with all kinds of investors. They start with liquidity, for example, that you can trade whenever you want, especially if you compare the ETF structure with a traditional mutual fund structure, where you often need to wait for your price and for your settlement as well. It's much quicker on the ETF side, and you have really choice when you want to trade. The next one is transparency, I think, which resonates more and more in our times, where people and investors in particular, they want to know what they invest into and can kind of aggregate their portfolio holdings as well. And I think we will discuss this later anyway. It's a very fair product. There are typically no share classes with different TR structures. So any investor, no matter if they buy one share or a million shares, will get exactly the same product at exactly the same price point. And all of that is very interesting and resonates well. I think up until recently, there were just maybe around 200 issuers globally, up until maybe 5, 6, 7 years ago. And this might be a reason that the accelerated growth is really happening now, because we see that many more entrants into this market. And with that, many more people are talking about ETFs as well. And the ETF as a wrapper becomes more diverse. But I think we come to that later anyway.
Yeah, I mean, I would agree with a lot of that. I think for me, like ETFs are, if you think about it like a technology, we'd be talking about it as a new way to do something. So mutual funds are sort of like the version 1.0, and then the next version of the operating model is exchange traded funds. I'll nail my kind of, colors to the mast. Like I'm a massive ETF proponent, and we always have been at Nutmeg. And I think there's sort of like three layers of advantage. There's an advantage to clients, and a lot of that is what Jürgen just spoke about, greater transparency, greater liquidity, lower costs, all of the features that if you wrote down on paper today what a fund structure should give you, you wouldn't trade off against them. Why would you accept liquidity once a day? Why would you accept delayed disclosure of holdings? These are just things that they're like old model. It's combustion engine versus electrified engine. It's that type of thought process. I think for us, from a portfolio management perspective, there's a huge amount of benefits as well. ETFs are just an asset allocator's toolbox. You've got such a choice of assets. You've got all of that liquidity and that transparency. Transparency for me is like absolutely key as a portfolio manager. And the idea that so many wealth portfolios are run with delayed disclosure doesn't make any sense to me. Like it didn't make sense to me when I was younger and we had issues when I was a fund research analyst, and these PMs would come to me and go, well, how much have we got in Argentinian currency? And the answer was, we had no idea. I'll tell you what we got 2 months ago when the fund manager last told us. We don't actually know. Like how is that an efficient way to run money? So like from a portfolio management perspective, I think ETFs have a huge transparency advantage that just like is sort of is often underrated. And then I think from a business perspective, why do you see so many fintechs building ETF portfolios? Hugely scalable. you know, the way that ETFs are run, the structure that sits behind them, the depth of the liquidity structure that firms like Jane Street and Goldman offer as well, you know, it means that we can be really confident in growing and scaling a proposition, you know, across hundreds of thousands of clients and billions of assets, and we see very little in terms of the ways of friction as we've done that along the way. So for me, there's kind of like three layers. There's the investment side, the client side, and then actually, frankly, from a commercial perspective as a firm, it's a really valuable structure.
Great. So, I mean, the client side, if I was to summarize what we just had, I know the democracy principle, the transparency principle, the cost principle, all of this really makes sense. I guess a very natural question would be the benefit to the client. What about the benefit to the wealth manager? I mean, I think, James, you touched a little bit about that, but do you want to expand on the how to actually use the ETF Advantage from a wealth manager perspective?
Yeah, so we obviously have a sort of cornered perspective on this, given that we only offer ETF portfolios. But we built our proposition deliberately around ETFs because of some of those core features. So I'm a big believer from a proposition perspective. If you build features that clients generally would prioritize over, you know, lack of prioritization in that proposition, it's going to be a stronger proposition. So, you know, do people want transparency? Yes. Do people want diversification? Yes. Do they want access to their capital in flexible ways? Absolutely they do, at least in the retail space. So, you know, for us, it's about how do we use the kind of scale of ETFs and also, frankly, like how do we give away less from a fee perspective? You know, the lower cost element of ETFs is not just about allowing clients to gain more from the returns that they generate and to have more potential, you know, vision of what consistency looks like there. But it also means that the overall fees are lower, the client's AUM's higher, we make, you know, a percentage of that AUM. We're aligned in terms of the compounding of that going forward. So for me, you know, the features really resonate with what people expect in wealth management products. And, you know, that's a key feature of why we think our proposition has been successful.
Yeah, I would see as well that wealth managers are using ETFs to offer a differentiated product to their existing investors. We see many wealth managers, very established ones, who offer managed portfolios with purely ETFs, and this seems to resonate well with clients because the ETF brand or the wrapper brand is very beneficial. You would hardly see in the media ever any negative articles about the ETF because, as Vlad said, it's very democratized, and that's what resonates well. When we look into winning new clients, I think many wealth managers use the ETF to issue products which helps them to attract new clients. And this could be, for example, launching their own multi-asset ETFs. This could be as well that they, when they have, I would say, the more wealthy tier as a major group they want to attract, if they want to diversify away and have maybe client groups which are more happy to be serviced with more automized ways of receiving a portfolio which is managed as well, then the ETF is a good wrapper. James mentioned as well that obviously on the fintech side, no matter what part of the fintech world, if they're the robot advisors, if they are online brokers, if they are ETF service plan providers, for example, they all seem to pivot towards the ETFs. So especially when you want to capture this younger audience, it seems the ETF resonates well. And a reason might be that we all, when we order food today, we expect instant delivery, everything needs to go fast, so the ETF fits into this bucket very well. You get immediate delivery, you kind of know exactly what you hold, and so I think it benefits the lifestyle which we are living these days, and these products fit in very well.
I think there's sort of like, there's a lot of innovation in ETF products as well that sits outside of people's normal thought process about, like, let's put an S&P 500 into a product and why that, you know, could be appealing to people. I think ESG is a great example. You know, like one of the things I love about ESG portfolios that are built with ETFs, in terms of how our clients resonate to that, is there's absolute consistency through all the products. And like one of the biggest things we knew was holding people back when we did our consumer research in 2018 on what we could build around ESG or responsible investing, is that people know there are lots of options. They just don't know what's in the funds, and they don't understand how to pick a fund in the US versus in the UK versus in Japan. ETFs just level that playing field. You know that if you pick a particular index style across a range of ETFs, you're going to get the same screens applied. It's very transparent. It's very clear. You know what you end up with at the end, and it's going to be the same in the US as it is in the UK, as it is in Europe, as it is in Japan, and it might even be the same underlying principles applied to the fixed income side as well. Like that's a phenomenal proposition, particularly as a wealth business when you're trying to engage clients around some of these core features, because understanding matters, and the reality is you're just not going to be able to drive that understanding without that consistency. I think there's lots of other examples. Active ETFs, another area, that's still pretty nascent, I think, really. But the reality is that there's a lot of opportunity there for people to get what they already have, just with greater transparency, greater liquidity, greater core features, really.
A PM in our house has once told me that if the ETF would have been first, he sees no chance that the mutual fund would have ever been approved by the regulators. And I think that's absolutely true.
These are great points, and I think this is actually quite interesting. I think you partly answered that, but if we're talking about ETFs as a new technology almost in investing, one could say, right, it's a new technology you're saying, but it's been around for more than 30 years now. Like, is it still new? Is it still innovating? Is it something that we can see as fresh and alive, or is it actually like in its maturation phase and this is going to be replaced by something else? So judging by what you said already, it seems that you are seeing signs of innovation, but I don't know if you want to expand a little bit more on that.
I still think that the ETF structure is very innovative because it's a vehicle as well which pools assets. And many people these days say that direct indexing will replace ETFs. I don't think so. I mean, direct indexing offers very specific, tailor-made solutions, but you are losing out on the advantages of pooling assets. And there are liquidity advantages, for example, or size advantages, which you get when you invest into such a pooled vehicle. And especially over the last couple of years, I saw tremendous innovation. So the ETF wrapper became successful by giving access to passive strategies. It started by giving access to existing indices, then over time, the index development process became more important, and James mentioned ESG as well, which was a key element of that over the years. But we see now really innovation when it comes to active management. We see that people package different content into this wrapper, which resonates so well, no matter if those are derivatives or multi-asset strategies, if those are target end date structures, for example. And I think what we see now as well is that many existing asset managers, wealth managers, other professional clients, they want to have their own ETFs, but they don't want to hire a big team, and then they partner with ETF service providers, for example, to launch their own products, which is another technology innovation. And that's why I think it suits very well to this conference where we talk about technology as well. So I definitely think that this technology is diversifying at the moment, and is a very interesting stage at the moment in the ETF market.
Yeah, I think probably we're at like a new second wave of innovation in ETFs, because I think probably the ETF disadvantage, if you like, for the last 30 years is you needed to be an ETF provider, or at least you needed to build that infrastructure. And I think for those of us that are in the kind of been involved in the ETF industry for a long time, like for as much as we love to like cheerlead ETFs, they are quite complicated behind the scenes structurally in terms of like how the market works and how you put them together. Slav would probably argue it's more simple than we think. But the reality is, like, you do need to, versus a mutual fund, if you've got an existing mutual fund business, it's a complicated thing to set up. It's a new thing to learn. But now there are providers out there that offer that white label capability. Yeah, that's a game changer for everybody, from big asset managers that want to get into ETFs through to like even businesses like us. Theoretically, we could launch an ETF now with a lot lower barrier to entry than we've ever had previously. So I think that's super interesting. And then, For me, like I think we're on the cusp of a lot of active ETF uptake. I know there's still some barriers there and some perception from active managers that they'll give away a lot of their secret sauce in terms of security selection. But I just really don't think that in the future we will have more and more active mutual funds launched. I think that fundamentally, you know, if you use a really simple example of liquidity, if I'm invested in an active security selection strategy today and I cash in $10 million of that exposure and Jürgen buys those same units next week, why is that getting cashed out in a mutual fund and then cashed back in when in an ETF it would be held at basically on Slav's balance sheet at a limited cost and would be purchased again? It's a completely inefficient way to think about capital flows in a giant ecosystem. And again, from like a PM perspective, like that's a massive advantage, right? You know, when you buy in, if you buy a significant value of high yield bonds and you're going into the underlying high yield bond market in a mutual fund or through a SMA or direct yourself, you're paying high yield bond spreads. When we trade a high yield ETF, we pay the cost of hedging and a little bit of a premium to the market makers. It's significantly lower cost on occasion, and you know, clients will benefit from that at the end.
Right. I mean, I definitely can confirm that, like, from the liquidity perspective, one of the advantages that we do see in terms of ETF being a wrapper is the reduction in the cost of accessing. And high yield is a great example, right? Like, you can actually trade the otherwise complicated and hard to access asset class through an ETF in one single trade, and the cost to execute and get the exposure in and out through an ETF is usually lower than the aggregated cost of doing exactly the same through a basket of bonds. And there are many, many reasons, and we can get technical if we really wanted to, but I think for many of the users, like, actually what is enough is that it's actually a very efficient and liquid tool. We seem to be very connected here in terms of our thinking, because one of the questions that came in was about, like, why to invest in ETFs now, since it's a technology in presence for 30 years. And I think even without me reading out that question, our panelists did a great job of sort of taking it on. So great minds think alike. Maybe a good reminder that we do have a Brella app for live questions. If you want to send more of those, that would be fantastic. And I'm sure our panelists will do a great job of answering those and leading your thoughts in terms of what's happening and what's next for ETFs. Something I wanted to ask as well is, we talked a little bit about how long ETFs have been around and how the industry looks like. From the manufacturers, from the issuers' perspective, again, I took a quick look before this panel. In Europe right now, we have close to 3,000 ETFs with close to 12,000 listings. Do you think there's space for more innovation in terms of products, more participants coming in as issuers, or like this is like already a very crowded space?
I think from my point of view, if you look into these traditional ETFs which have been launched first, all of these S&P 500s, Euro Stoxx 50s, emerging markets, MSCI emerging markets, for example, there's clearly a lot of choice out there. And in some of these categories, you see 10, 20, maybe even 30 different products who are fighting for your assets. And I have rarely seen new launches into those categories over the last couple of years. Maybe just if there is a new structure available, for example, to replicate something synthetically, and this might lead to performance advancements. But otherwise, I think this market is very well distributed. And it would be hard today as well, because the costs are so low, the TRs, to disrupt that market. You see from time to time that even big issuers, they drop the prices on those products, but for new market entrants to become profitable in those is almost impossible. So I think all of these new launches which we are seeing, they are providing innovating content to the market. And I think we will continue to see that. And at the same time, what I would have experienced over the last couple of years is as well that funds which are not profitable they are closed down quicker these days than in the past, especially in the interest rate environment which we are in now. And James mentioned as well, ETF is a structure which can be complicated to manufacture. So that's why you need either a big team or you need a partner who can help you there. And at the same time, because it's a fund structure, it can be expensive as well. To set it up, there are many legal costs, you need to pay boards, and it's a very well regulated structure. That's why it's interesting for investors to be invested, because because of the segregated nature of the assets, you're very safe as an investor as well. So I think we will see both. We will see fund closures of products which might not resonate well or where the timing didn't work out well. And we will see an avalanche of innovating content as well, no matter if that's giving access to new asset classes, putting together asset classes in an innovating way, or as well to provide active content.
Yeah, I mean, I think there's a lot of room for differentiation. If we had like £1 for every time somebody had come into our office and said they wanted to launch a lower cost product that is going to be very difficult to justify moving to, definitely have a little bit more money in my ISA than I do now. But yeah, I mean, I think again, the active space is a huge area. There's so few people playing in that, and there's I think most people think of Nutmeg as sort of like a passive investor in the sense of, we've been ETF focused. We're not anti-active by any means. We're just actually sort of anti some of the characteristics of active through a mutual fund, i.e. lack of diversification, lack of transparency, all those same things again. The fact that we use active ETFs in one of our propositions today, and they work really, really well, and they really appeal to people. So I think there's a lot of phenomenal strategies that have been running a long time in the equity space and the fixed income space that can be translated into ETFs. And then also around ESG and engagement, there's a massive opportunity there in the ETF space for innovation. I think from our perspective, maybe we're the only firm that thinks like this, but there is an appetite to take on some level of tracking error in ETF products where there's a layer of, say, like engagement or stewardship going on around that. Same for ESG. I think there's a lot of firms that are using ESG indices and analytics. That's fantastic, but like, what about your IP as well? Like, what about all those meetings you have with companies? What about you as a shareholder? Can you layer that on top? It seems ripe for disruption. That still.
Maybe one point which you mentioned, Slav, with 12,000 listings, there's clearly a lot of choice. And as a retail investor, you struggle to navigate that. I think professional investors, they have big teams to choose really the best suitable universe and the best suitable product to replicate that. And some very advanced investors, they even go to ETF issuers and demand certain structures. So we see that as well. But I think for that reason, and we are here on a tech conference, I think there is a lot of opportunity for technology to help those investors. And I think that's exactly what's happening at Nutmeg, right? I mean, you get an easy compass to invest with somebody who takes care of your investment with this overlay of a portfolio structure. But there might be some or many other solutions as well which might help those investors to really invest in a way which is beneficial to them.
So not to labor this point too much, but I thought it was interesting combining a little bit what you said, James, in the beginning about that it's now possible for firms like yourselves to think about launching an ETF given some of the enablements. And then all the talk about like what exists and what doesn't exist in the market. Would you mind like talking a little bit more from like a wealth manager user perspective, like when you wake up in the morning and you say, hey, I would love an ETF to cover this, and there isn't one. What would be the pros and cons in your mind of like manufacturing, like moving to the other side? Like, is the boundary between manufacturers of ETFs and users of ETFs blurred or getting more blurred?
Good question. I don't think it's blurred today because I think they're very different activities, very different regulated activities in fact. And I think the let's be honest, the infrastructure that's required to run a wealth firm and the infrastructure that's required to run an ETF business are, in my mind, like actually quite different things. I'm sure they are in other people's mind, because they actually are very different things. Yeah, I mean, I think I use that as an example because, you know, over the years, we've thought about that, particularly when we were an independent business. We thought about it a lot. You know, how can we do this? We spoke to various different asset managers about it as well. And part of that was about lowering costs for consumers, because when we started, you know, people forget when Nutmeg started out, S&P 500 hedge cost 45 basis points. You know, it was a crazy high cost for something that is as cheap and efficient as it is today. And so we sort of set about thinking about how we could do that. I think what we found is that actually by seeding new products with providers, we could achieve the same goal without necessarily having to participate in the underlying infrastructure. And then also, you know, where you have, I think you need to have an IP, and frankly speaking, I don't think Nutmeg has an IP in terms of weighting the US index any differently to the way that S&P or MSCI or anyone else wants to do that today. I think if you're an active house and you've got an IP that you want to apply, or you're an ESG engagement business and you've got an IP that you want to apply, I think some of the stuff that some of our fintech peers have done around ETFs in that space is really exciting, really interesting. But I think, you know, when it comes to purely commercials, even though today, theoretically, we could go to some of these white label partners and launch a product, you know, it's a huge amount of effort to deliver something that's probably still going to cost 5 basis points and still replicates the S&P 500. So it might have our brand on it, but we're not achieving a huge amount commercially or for clients for the bulk of our portfolio holdings. It's just I think if we had that 5-10 years ago, it would have been a completely different story.
Jürgen, do you, in your job, do you meet and speak to people who are what James described, I know, boutique active managers or wealth managers who have like an idea for a product and feel that they have some special IP and they want to deliver this through an ETF wrapper?
Absolutely. And I think especially in the States, so we are a global business in the States, we see that the interest in the ETF wrapper is huge. That's why we see a lot of conversions as well. We even see companies who convert all of their products or parts of their products into ETF structures. There's a tax advantage as well in the States, which really helps with that. But I think in the States, it's almost impossible to avoid. And I think in Europe, we get there as well for all the good reasons which we described before, that people want ETFs. And that's why the number of issuers has increased so much over the last 5 years. And people have a couple of choices to do that. So they can either hire a team and build the ETFs themselves. The cheapest, what I've seen, was a startup. They spend around 3 million to do that. But established companies who want to be successful, they tend to hire somewhere around 15 to 20 people. And then it might take around 2 years. And they need to spend, for all the costs, internal costs, other costs, around 10 to 20 million until they have their first product live. Then the other chance is to buy an issuer, which happens as well. There was a transaction recently which was published in the market. But again, you spend a couple of million. If you want to buy a more sizable business, you spend more. And then the third way would be to partner with a white label provider or with an ETF service business like ours and start into this business with no significant initial cost, but obviously paying a charge to those who help you to do that. And we see that that becomes more and more popular. And the number of clients we talk to is astonishing. I would have never expected that. And the size of clients as well. So we are talking to super big asset managers. 60% of the clients we talk to are asset managers. Then a lot of private banks as well. But we are talking to online brokers. We're even talking to hedge funds. We are talking to established ETFs businesses, which either have already somewhere on the continent in a business and want to come to Europe, or which have a European business, want to come to other parts of the planet and use the ETF for that. Or we even talk to established businesses who see that it's very hard to get to scale and want to use a service platform. So all of these different routes are possible, and we see increased interest. And I think the interesting part of a ETF service business is that as a client, you are seen as the ETF issuer. You would use the structures, we would help you to set up the business, we would help you ongoing as well with portfolio implementation and capital markets, so all these things which make the ETF different to a mutual fund. But you are the investment manager, you are the one who is seen as the issuer in the market. And I think that's an interesting proposition for many clients.
Great, thank you. Maybe let's move a little bit on from talking about ETFs as a product to talking about how to actually fit them into portfolios and your investments. And James, since this is a technology summit, can you talk a little bit about how technology is an enabler or a limiting factor in terms of how advisors, wealth managers use ETFs, think about rebalancing their positions, valuing their positions?
Yeah, absolutely. So yeah, I mean, I think there's no doubt, like when you look back over the last sort of decade or so, that probably one of the reasons that slowed ETF growth from an advisory perspective in the UK is some of the legacy platform technology that's there and that isn't as efficient as maybe certain parties would like it to be for the advisors. You know, I think that's largely because we come from a kind of mutual fund construct in the UK in the way that some of that tech architecture has been put in place. I think that's changed a lot in the last decade. There is a lot of options available to portfolio managers today to run ETF portfolios in a really efficient way. Lots of solutions that are white labelable as well, from you know, headline providers through to kind of more boutique fintech firms. You know, I think probably one area where, you know, just speaking from our perspective, you know, we built a proprietary portfolio management system. We're really a technology firm as well as an investment business. That included things like fractional shares, the ability to net trades between clients. So we net about 40% of all of our trading volume every year gets netted intra-client. So if Jürgen's withdrawing and I'm paying in, there's no need for that trade to go out into the market and to suffer a bid-ask spread. You know, there are other solutions that do very, very similar things, but the principle of that is to try and draw out some of the advantages of, you know, secondary market liquidity, i.e., you know, units can be bought and sold between participants in the ETF market, very unlike other types of fund products. But I would also readily accept that is a lot more difficult to do than mutual funds. And I think, you know, I was joking with somebody the other day actually, because I said I was surprised over the years that no VC ever asked us. So what you're doing is building a big fractional engine at great cost and great expense, and having to navigate a really complex regulatory landscape to do the same thing that you can already do with mutual funds, which is fractional ownership of fund units. And when you actually think about that, it's, you know, you do have to work harder from an ETF perspective to do some of those things for retail. But I think at a wealth management level, that's absolutely not true. And then when you're also blending equities with funds, then ETFs just sit side by side with that, because you've got a very similar execution avenue, very similar type of settlement periods, all those types of things. So, yeah, I mean, you know, technology-wise, I think we've come a long, long way. I think if you look at where there is true retail growth in European markets at the moment, I mean, take Germany as an example of ETF savings plans, you know, where you've had businesses build around the ETF structure. Phenomenally interesting example for the rest of us. Yeah, I mean, you know, we were looking at some data the other day, actually just looking at search terms in Germany around ETF and around savings plans and around mutual funds relative to the UK. And UK search terms for retail investors, everyone's looking for mutual funds still. But in Germany, nobody searches for mutual funds. Nobody even searches for savings plans. The thing they're searching for is ETFs. So by embedding those like very early, you know, building the solution around the distribution solution around the product itself, I think has really led to a kind of probably what was quite unforeseen 5 years ago in terms of growth in Germany.
And I think it's all spiced up by the fact as well that retail investors need to take their financial future in their own hands, with maybe other pension systems being not as reliable, especially if you want to have a retirement where you can rely on I would say a better capital growth up until this stage, right? And I think if you can take it in your own hands, then you need solutions for that. And it's very good to see that I think European-wide, the number of shareholders is increasing. It's still very low from a retail point of view. I think in Germany, it's now 13 million shareholders who hold either shares, bonds, or ETFs. In a country with more than 80 million people, so it seems that most of them are still not invested, but that gives me comfort that there's a great future for propositions like those, and I think that more and more of those retail investors will feel empowered. And when you look at these statistics from some management consultancies, you definitely see that the retail part of global investments is growing. And I think that a big part of those retail investors will use ETFs.
Yeah, but I mean, I think the opportunity for everyone here is about, what can we provide to the traditional industry as well from a wealth management tech perspective? Because, so many of the private conversations I have with peers in different, different types of wealth businesses are that they would like to be using more ETFs, but there's a struggle around getting access to some of that technology and what that technology change program looks like in certain types of businesses. But there are a lot of white label opportunities out there, and there's a lot of opportunities to use service partners to develop these types of propositions. I still think there's a great opportunity for fintech to kind of strengthen the links in there as well.
It's a great time to, we still have a couple of questions through the app and lots of things to talk about, but as we have just about 10 minutes to go, if anyone has questions that they want to ask in the old-fashioned way, that would be...
Hi, I'm Ian Cowell, Franklin Templeton.
There's a mic, sorry.
Oh, thank you. Jürgen, interesting question. You work with a lot of people setting up ETFs. How are you helping them to differentiate? Because my assumption is James will go and choose the cheapest ETF, an S&P for 3 basis points. How are you helping people to try and differentiate their ETFs?
Yeah, so on our platform, there are 2 things which our clients have fully under their control. One is the investment content, and the other one is the distribution as well. So we help manufacturing the product and then maintaining the product in this ecosystem. The investment content is something which they will take care of. But so far, in all of those client conversations, we were surprised about how many ideas and how much creativity and how much possibilities are on that side. Think about this whole artificial intelligence infrastructure. And I don't mean this from a thematic point of view. I mean it more leveraging AI, for example, to come up with innovative content. Or big asset management companies wanting to bring their flagship funds to market. And I know you have your own ETF business, obviously, but there are many of your peers who choose a different way to leverage that, and they know their client base very well. And they know that if they now have an ETF structure for somebody who managed active mutual funds for a very long time, there's a big... It's a brand name. This money manager is a brand name in the market, and people will then naturally be kind of attracted by this brand name and would then use the ETF, for example, if they have a neo-broker account where they can't buy a mutual fund, for example. And we see as well the hedge fund space is very interested in the ETF wrapper. And again, there's not a lot of competitive products out there yet in ETF structure. And for the hedge fund space, this would mean that they would dramatically broaden their client footprint, for example. So we see really clients who have existing holdings, client holdings, who they want to get into their own funds. We have insurance companies, for example, who have a very specific ESG demand and want to manufacture an ETF to satisfy that. And so I think it's not always about price. It's really about which content do they want to deliver. And when I look into the States, where the active wrapper is very successful already, we see that content around 55, 65, even 75 basis points, some of those even up to 100, can become very, very popular. Especially if you can tell a story to retail, or if you have very specific demand. And I hope that James would be attracted as well to some of these differentiated products which our clients might launch.
Yeah, always quality over price.
So a question that came via app is any suggestions for investors who are looking to dip their toes into ETF market for the first time? Does it really matter like what you choose as a starting point? Are all ETFs the same?
No, I think not all ETFs are the same. I have to be careful about what advice I give here. But I think, no, I mean, my advice would be stay diversified, look for, large liquid products. Yeah, I mean, I think part of the challenge with self-investing with ETFs is sort of understanding some of those liquidity dynamics that maybe not, maybe aren't just as apparent. But I think don't let that put you off. The reality is, the reason these ETF products in Europe are so big and so popular is because of the quality with which they're run. Yeah, it's probably about all the investment advice I can give on a stage.
We have one more question then.
Probably a question James would be more comfortable answering. With regards to how people can access ETFs as well, there's obviously a plethora of ways people can go via the traditional platforms, digital wealth managers. What's your thoughts in terms of how someone dipping their toe into using ETFs or investing more generally should look towards a service provider?
So I have a bias on this, obviously, because of where our business sits. But one of the reasons we founded our business, or Nick founded the business back in 2012, was because up until then, unless you had enough money to be with a wealth manager, your option was to go and just buy products, like walking into a supermarket with shelves of products, even if you're completely inexperienced. What we try and do is build portfolios for people to help them achieve goals. So, we take into account your time frame and what you're trying to achieve, and we create that solution for you. So I think the answer is whether you're looking for a solution, and you know what your time frame is and you know what you want to achieve, or whether you're looking to dabble and trade in financial markets. That for me is the difference between a sort of advised, diversified portfolio structure and going on and trading ETFs themselves. Does that answer the question?
We have maybe about 2 minutes to go. So one final thought from each of you about the future of ETFs? Something disruptive, something interesting? What we're going to see continuation of growth, something new?
I'd like to think that at some point in the next 10 years, and maybe it'll take longer than 10 years, that the active ETF landscape will grow to a point where it is equal to the kind of wider active mutual fund landscape. Maybe 10 years is too punchy for that, but I'd like to think they'll be able to come back here in 10, 15 years, and that be the case, because I genuinely do think that, like we said at the start, it's, if you treated it like a new technology, you'd be talking about why would you use iPhone 8 instead of iPhone 14. It's a completely different structure. It offers you completely different things, and you wouldn't go backwards.
Jürgen?
Yeah, I think for me the retail adoption is the major changing factor over the next couple of years, and I think on the product side that we will see a lot of differentiated content, and maybe to James's point with active funds. So in Europe, just 2% of all ETF assets are right now in these transparent active ETF wrappers. In the States, it's already 7%. And so often on the ETF side, the US was really front-running Europe, and I think this will be another field where Europe will follow with a couple of years difference.
Yeah, maybe what we'll see as well is maybe we'll see a wealth manager launch in the same way wealth managers have often had their own multi-asset funds in-house. Maybe one day we'll see a wealth management ETF. I think that would be a big kind of line in the sand for development. And
we hope one day is tomorrow.
Great. I think sadly we are out of time, but we have some predictions. So if you see any of our speakers in 10 to 15 years time, you could keep them accountable for what they said. And all of us love talking about ETFs. So if you want to have follow-up questions, just grab us after this as well. Thank you.
Thank you so much.